The U.S. economy has changed dramatically over the past 40 or 50 years. Someone mentioned earlier, it may have been Bob or Russell, I can't remember who in the panel discussion, talking about wages. Look at the role of unions in the United States economy. Go back 30 or 40 years when the auto workers, the steel workers, the machinists, and other big unions in the United States were extremely successful in getting their companies to push up their wages, push up their benefits, and they all had cost of living escalator clauses in it. So if the CPI went up, the Consumer Price Index, they would get a further increase in their wages or salaries on top of what was negotiated in the contract. And what would happen? Do you remember the 1970s? We had an oil price shock. You're all aware of it. Crude went from, what was it, $3 a barrel to whatever in 1973. That increased gasoline and heating oil prices, increased the Consumer Price Index. GM and all those unionized industries had to increase their wages to their workers. That raised their costs, so they raised prices of their products. And before you knew it, we had a wage price spiral. Some of you probably are too young to remember it. You know, we had 12 and 13% inflation in this country in the late 70s and early 80s, largely because I worked for IBM then. And one of my jobs at IBM was to make sure that we pay our workers good enough so they won't try to unionize our company. So I got pretty knowledgeable about wage trends around the United States and union contracts and whatever, because I worked with the compensation people. So we did the same. We raised our wages just to keep competitive, and our costs went up. And this ratcheted throughout the economy. Do you see any unions now getting big wage increases and having big cost of living adjustments? Most of their bargaining these days is to prevent givebacks. So that is a structural change. And in fact, for the last 6, 7, maybe 8 years, wages among unionized workers have gone up less rapidly on average than non-union workers. Not in every case, but on average. Extraordinary. Secondly, look how competitive the economy has become. Talk about the auto industry. Do you remember when Chrysler, Ford, and GM and most other industries as well were dominated by two or three companies, manufacturers? You know, now you've got more domestic competitors, but in the case of the automobile industry, there are 26 foreign-based companies selling cars in the United States market. You know, go back to 1970, the big three had 90-some-odd% of the U.S. car market. It dropped below 50. It says moved back up a little over 50 now during that period. That has restrained price increases in many industries. Look at retailing. I mean, now you can buy at a traditional department store, one of these new mega stores, you know, Walmart or Staples or Home Depot, those kind of stores. You can buy online. You can buy on the internet. If there are any left, you can buy at small retailers. Retailing has become extraordinarily competitive. And most retailers can't raise prices, especially since one of their biggest competitors is Walmart. And Walmart just does not accept price increases from their vendors and doesn't raise prices to the consumers, for the most part. Obviously, there are a few exceptions. But retailing has gotten so competitive that the freedom to raise prices doesn't exist anymore throughout the retail sector. I mentioned foreign competition. In a lot of industries, particularly as the economy has been sluggish, you're getting new domestic companies moving into some industries or some geographic areas to compete with everybody else who is there because they want to grow their revenues faster. It is deregulation. I talked about manufacturing. You know, it's only been 26 years, I think, since long-distance telephone service, which was an AT&T monopoly, regulated by one of the federal regulatory agencies, was broken up, and we now have competitive phone service. Now you not only can go to Sprint, or I guess MCI is not there anymore, but one of the other providers, you can use your computer to make telephone calls. It's extraordinary. Your cell phones, extraordinary how much competition there is in telecommunications now. Even at the local level, we've begun to see it, as I think most of you know. Electric power is slowly being deregulated. Banks, You know, years ago under Glass-Steagall, they couldn't sell insurance. They couldn't get in the brokerage business. Unfortunately, in my opinion, that was rescinded, and they've all done that, so they become competitors for the other financial institutions in these other markets and industries. And I think it led to some of the excesses of the last 10 years, but we'll skip that for now. I can spend the next half hour talking about other structural, long-lasting changes to this economy that have changed we had a bias in this country years ago toward inflation. When the economy would get better and better, this would give companies more freedom to raise prices. They generally had very limited number of competitors. And quite frankly, when I was at IBM and I was involved in the planning and budgeting process, our costs went up, we raised prices. That doesn't happen anymore in most cases. Most companies I work with now start their annual planning with the assumption they can't raise prices. And they work backwards. How am I going to improve efficiency and productivity to make sure I can maintain my profits and profit margins? It is a complete flip-flop from the way they did things years ago. And plus, we have way global overcapacity in most industries now. There is no chance of any significant acceleration in U.S. inflation in a long, long time. Certainly 5 years, if not longer. And we haven't had any. Look what happened in the 1990s. We had the biggest boom in our history. We had no inflation. Unemployment was down nationally to 3.8%. Did you see any inflation? So why these inflation predictors are still out there, I do not understand. And you see commodity prices. I mean, there's not a real close relationship between overall inflation and commodity prices. The only one that's big enough to affect it significantly is oil, of course. But they're going down, not up. The dollar is stronger. That holds down inflation. Wage increases may be accelerating a little bit, nowhere near where they need to be to push up costs because companies are finding ways to increase productivity, a lot of it through new technologies. Not only do they start their budgeting with the assumption they can't raise prices, one of the highest priorities in every corporation now, how do I improve productivity and efficiency? I mean, when you think about it, you got to get 3% better each year just to offset your cost increases, or 2% better, just to stay in the same place. And they're doing it. And they're going to continue to do it, particularly as more of the new productivity tools start spreading to companies who are not yet using it. All right, and deflation, ignore that. Deflation in this country only happens in the 1930s. We need a major depression to cause deflation. Isn't going to happen. We're going to have inflation of 2% a year, 1.5%, whatever, as long as we can look out ahead. Second issue is the Fed and interest rates. And I'm going to try to shorten this so we get through it. I don't know when the Fed is going to, the QE3 is now over. I don't know when the Fed's going to start raising short-term interest rates. But remember this, they won't be raising them to stop inflation or reduce inflation or prevent inflation, nor are they going to raise them because the economy is growing too rapidly, which could lead to inflation. They're going to raise them only to get short-term interest rates back to a normal range instead of zero, or close to zero. As a result, they're going to take their time. They will probably start doing it 25 basis points at a meeting, the federal funds rate and the discount rate as well. And at the next meeting, unless the economy's changed a lot, they'll do another 25 basis points. Most likely, they'll do that for roughly 8 meetings. So from mid-2015 to mid-2016, most likely we'll get something in the range of a 2 percentage point increase in short-term interest rates. At the long end, and talking about structural changes in the economy, if you go back 40 or 50 years ago, long-term interest rates in this country never rose until the Fed did something at the short end. If the Fed raised short-term interest rates, long-term interest rates would follow, at least directionally, not necessarily every basis point for basis point. And when they did the opposite, long-term rates would go down. In the last 30 years, every single shift in the direction of interest rates has started in the long end of the market, the Treasury market. The Treasury market is now a trading market. 40 years ago, it was an investment market. You bought long-term Treasuries as an investment vehicle. Some people still do that now, but it's much more a trading market. You know, and I haven't updated this number. I looked at it about 7, 8 years ago, the amount of trading in the Treasury bond market. The average 10-year Treasury changed hands every 9 minutes. That's how much trading there. And there's 13 billion, now there's whatever it is, 16 billion of Treasuries out there, some of which are owned overseas, as you know. So my best guess is sometime over the next 6 to 9 months, long-term rates will start going up. They would have already been going up, except for what's happening in foreign countries. Some of you may know this. Long-term interest rates in almost every major country in the United States and some of the non-major industrialized countries have gone down dramatically. If we take the eight biggest economies outside the U.S., Japan, Canada, Germany, France, Australia, whatever, our 10-year Treasury, which is now yielding about 2% plus 235, is up a full percent higher than the average elsewhere. In Germany, it's 1.5%. Their current 10-year Treasury rate is 0.9%. Never has happened before. As a result, we had by far the biggest flow of investment capital from overseas into the U.S. bond market, and some of it the stock market, than in our history, and biggest sales of U.S.-owned foreign bonds in our history. That's what's keeping interest rates lower. Plus, the deficit this year is lower and so forth. But that's the major factor. Sooner, those economies are relatively soft. Sooner or later, those rates will probably go up. And when they go up, ours will go up and probably will precede the Fed,